Hi there, everyone. Thanks for starting your day with us. This is The Market. I'm Avan Dabash, with me, Nikunj Zalme, as well as Anisha Jain, right here in our Mumbai studios. And I think that as we step into trade this morning, the key focal point is going to be central banks across the globe and back home. Well, you did have, stocks on Wall Street closing in at session highs. It was a pretty volatile day of trade, but by the time they wrapped up, you had the Dow Jones in the green, the Nasdaq as well, which outpaced the other two indices, gaining about 2%, while we yesterday wrapped up the trading day absolutely flat around the 17,721 mark. And of course, the commentary that came out from the US Fed Chair Jerome Powell clearly seemed to be the focal point. He said that inflation is easing. He reiterated comments that he made just in a conference last week that really seemed to have raised investor hopes that now the Federal Reserve could perhaps pause or maybe pivot that interest rate hike. And you clearly saw Wall Street reacting to that commentary. The Asian markets a little bit mixed this morning, but clearly it seems that investors have acknowledged that inflation is declining. You also have US President Joe Biden's State of the Union speech, State of the Union that's already started and being closely watched. But Nikunj, clearly central banks are going to be the key point. The impact of Powell's comments has seen a reaction in the VIX, the 10-year yield, and even the indices on Wall Street.
You know, it is pretty much on expected lines that the worst of the inflation print is hopefully behind us, and in the near term we are in for a measured rate hike. But when the central bank or US Fed endorses that gives the market in the short term a reason to really rally. So I'm not surprised with the kind of comeback what we've seen in crude and what is happening to the dollar index. So that pretty much is on expected lines. Are we reaching that pivot that beyond one hike, the interest rates in the system will peak out for a long time? So today markets are breathing a sigh of relief, and especially commodity markets, that the worst of the inflation print is behind us. The automatic impact is you will always see crude, you will always see copper, you will always see industrial metals, they will rally. And adding to that, I think, is the China factor. But what I would be what I think is of immense curiosity, it really would be that if interest rates are peaking out, what happens to some of the growth stocks? What happens to some of the tech stocks? So for me, while we've spent a lot of time talking about the inflation concerns and banks and what kind of gut-wrenching fall we've seen in some of the some of the Adani group of stocks, I guess for me the real outperforming index this year has been the IT index, something which we'll talk about going forward. So what Fed has indicated last night, expected lines, but in the near term there definitely is a relief rally because of that.
Yes, on expected lines, because at least as you pointed out in inflation, they said that the disinflationary process has started. Of course, there's a long way to go for that, and they'll reach the 2% mark perhaps only next year and not this year. But there was a bit of a hawkish tone as well, because he did point out that the policy needs to be restrictive for as long as required, and the fact that if the economic data continues to be quite strong, in fact, the weight was strong in the jobs data that we saw last week, they will hike the rates more than what the street is penciling in, and that actually turned the tide for the markets a tad bit. So it was very choppy on the Wall Street yesterday as well, and it was choppy on the Lal Street as well, because ahead of these big events which are lined up with respect to the Jerome Powell commentary and the commentary that we'll get from RBI governor today, the market was a tad bit tempered. The Nifty ended the day around that 17,720 mark. It was sectors like autos which were on the back foot. You also had FMCG that was not doing well, as ITC was under pressure, and media, IT, metals were some of the other sectors in the red. Banking managed to outperform yesterday. It was up almost 0.25%, and names like Kotak Mahindra Bank, IndusInd Bank were doing well. Nikunj, we talked about the global central banker and whether it was on expected lines or not, but what about the RBI governor today? What are you waiting to hear from him? Do you believe there is any chance that they could surprise us?
No, RBI rarely surprises us. They've been very predictable. You have to grant to them, because you don't want the central banker to surprise you. And I don't think Reserve Bank of India is going to surprise us. You've got to grant it to them that the way how the economy has been handled by Reserve Bank of India, and the fact that they, in a sense, have been very predictable, very forthcoming, very open about the communication, that really from a market standpoint may just end up making today's RBI policy more like a 100-point Nifty event, 150, or a 200-300 point swing event on the bank Nifty, because that is not what markets are really betting on in terms of a communication. I don't think anything new or anything scary which is expected from today's credit policy. Even if interest rates they go higher by 25 bips, which is what is expected, I think it would be on expected lines. Second, I do expect Reserve Bank of India to come out and indicate something, at least in terms of the market, uh, market stability and the financial or the bank's exposure to Adani group of stocks, because this is the first time Reserve Bank of India governor today is going to be speaking on the public forum after the rout in some of the Adani group of stocks. I expect something really on that account you are likely to hear. So the policy framework, I think, even if it's 25 bips, which it will be, it is on expected lines. But from a market standpoint, the curiosity would be huge. The curiosity would be there in terms of any official word from Reserve Bank of India on Adani group of stocks and what kind of risk management is in place when it comes to banks and banks who have exposure to Adani group of stocks. But here's an interesting bit. Since we are talking about rates here, where were rates a year ago versus where rates are right now, whether it is home loan or car loan, whether it is personal loan or whether it is a corporate loan. Now that's the GDP growth trend. We are not getting into the GDP growth trend, but that's where the rates were. I mean, isn't that amazing? Exactly a year ago, rates were at 6.75, now at 9, and they are inclined to go higher. Inflation has been static, which is the point I want to bring out. That rate hike in a sense has worked and inflation has not really spiraled out of the hand. Repo rate is a function of underlying Reserve Bank of India tightening, which I think is getting reflected, and rupee is at 82.8 despite weakness in the rupee. So the point I'm trying to make here is that rates have gone higher, rupee has weakened, and inflation is showing signs of peaking.
Yeah. But just addressing, Nikunj, what you were saying with respect to the Adani group of stocks, hammered for 8 straight sessions after that report by Hindenburg. But then you've seen that recovery kick in and how, and that's something that I'd just like to address, how some of these stocks are off from their 52-week lows. For instance, Adani Enterprises close to 77% off the 52-week low. 92% for something like NDTV. Adani Ports in the past 2 trading sessions, I think, has really proved its might, and that stock has seen a commendable recovery. Ditto when it comes to the entire group of stocks like Adani Wilmar, ACC, etc. Nikunj.
Yeah, I mean, first the fall was unreal and then the comeback is unreal. So really unreal things are happening in terms of where the price action is. This is extreme volatility on both the end. What the trigger point really may be for some of these stocks is that, look, the promoter has gone out and is using their personal balance sheet to remove the loan against shares, and that's the news which I think came on Monday. Market reacted to it on Monday, they acknowledged it on Tuesday, and I think that repair work in some of these stocks will continue. Adani group of stocks will remain volatile. Very difficult to say where the worst is behind them in terms of an immediate price action or not. But from a market standpoint, given that we've heard from Reserve Bank of India, we've heard from the finance minister, we've heard from LIC, we've heard from SBI chairman, other banks which have exposure to Adani group of companies, all of them have in a sense endorsed that there is no systemic risk and there is no financial risk. There are 2 things here. One, is there a business risk for Adani group of stocks? Does not look like. They've in a sense kept up to all their commitments in terms of the loan repayment. Second, what happens to the stock market? That's a secondary market issue. And within that also, some would argue and say that a lot of pressure, technical pressure in some of the Adani group of stocks, I think now seems to be reducing. Having said that, it's very difficult to say whether they will turn volatile or not. But I would imagine that if you are trading or investing in them stock, if you are trading or investing in these stocks, you have to be prepared that these stocks in the short to medium term will remain volatile. They could remain 2 ways because there are a lot of factors which are at play there.
Yes, a lot of factors at play, and as somebody rightly put that perhaps the elephant is out of the room, but the tail is still wagging. So you need to watch out for whether the worst is behind us or not with respect to the volatility in the Adani group. But coming back to the point that we were making about the central bank being in spotlight today, let's discuss all of that with Jeff Dennis, the independent emerging market commentator as well. Jeff, hi, good morning. Thank you so much for joining us on ET Now. First up, just wanted to understand what was the key takeaway from the Fed commentary yesterday for you? What really stood out?
Well, I think the thing that stood out is the 2 obvious things, which is, first of all, Powell confirmed that indeed the disinflation process has started. That's very clear because inflation peaked at 9.1% several months ago and is now 6.5. And although core inflation has hardly come down, it has come down a bit. You can clearly see the disinflation process has started. So the market liked that, although quite why they were surprised by that, I don't know. And then the second point, the second clear takeaway is he was hedging his bets a little bit on how strong the economy is because of this extraordinary employment report that we had on Friday, which is really, is really sort of unsettled everybody. Nobody quite knows what it means. So I think you're getting what you want, which is lower inflation. Wage inflation is behaving well. But the labor market is puzzling people. And so there is a fear, I think, out there that the Fed will have to do more than anticipated previously if that labor market strength eventually causes inflation to go back up again.
Do you think it's too early, Dennis, to say that Fed has managed a victory against the inflation?
Oh, no, I don't think it's too early. I think it's definitely gaining a victory. I mean, there's some way to go. I mean, I ran some numbers today. If you get 0.3% inflation per month over the next 6 months, inflation is at 4.7 by March and 3% by June because the base effects, the comps are so relatively good. And so I think there's going to be the usual shifting around, or gasoline prices are probably going to be pushing inflation up in January, then pulling it back down in February. Food prices are coming down. And obviously what Jay Powell is most concerned about is still services inflation. But frankly, I think inflation is on its way down in the US. And my own view is that there's no guarantee that the 2 further rate hikes of 25 basis points that the Fed had penciled in last meeting, there's no guarantee that that's going to change. My gut feel is that's still going to be the case. We'll get 2 more rate hikes to 5.25. What I think the strong labor market does is probably make rate cuts later this year, which I never thought would happen anyway, extremely unlikely. But I think I'm trying not to be put off by this strong labor market. I still think the whole story is intact with inflation coming down and the Fed nearly finished with its tightening.
So what's your outlook then, Jeff, as to what you expect the trend in terms of the US 10-year yield, largely on the basis of the kind of commentary that we've got and what you're expecting ahead from Jerome Powell?
I think we've seen a big sell-off. We've seen yields rise by about 25 basis points over the last few days. I think once again, I think you buy the bonds back. I think it's, you've had that sell-off, and I think next week we're going to get another very good inflation number, which is going to pull the year-on-year rate down. As far as I can see, anyway. So I think bond yields are going to start to go down again, and I think also the dollar will start to go down again. Dollars rally about 2 to 3% of its low, which has contributed to emerging markets pulling back a little bit over the last couple of weeks or so. So I think you'll get all those trends looking quite good over the medium term, if you like. If I can just say this as well, I think the most interesting thing that's going on here is the behavior of the labor market. Frankly, I don't really believe that 517,000 job growth that was reported for January. I think it sounds very freakish. January is often a surprisingly strong number that's out of line with consensus. I think it may well get revised down sharply, or it may well be followed by much, much weaker data in February. And I think the seasonal adjustment factors have played a role there as well. In other words, I think over the next month or two, it'll become clear that the labor market is not as strong as that data would indicate. And in that event, I think you buy equities, I think you buy bonds, I think you sell the dollar, and I think emerging markets will continue to will begin their rally once again, and you'll see emerging markets having a nice year in 2023.
Okay, on that optimistic note, Jeff, we'll let you go. Thank you so much for joining us. Emerging markets can see a bit of a rally this year. Let's wait and watch out for that, because for now, at least the Indian markets have haven't rallied that much this year. In fact, yesterday as well, we had seen the Nifty around that 17,720 mark. There is a broad range of 17,700 on the downside, and 17,800 has been acting a bit of a resistance level. So for the last many days, we have been meandering around this range. If you look at sectorally, it was metals which was coming under pressure, understandably due to the earnings of Tata Steel as well as Hindalco, and you had the impact coming in for Vedanta as well as Hindustan Zinc as well. Autos was declining for second straight session yesterday. Let's see how the auto index performs today, because Hero MotoCorp came out with a good set of earnings overnight, and the gross margin expansion is quite positive, and the management is quite confident about a double-digit revenue growth in FY24 for the entire industry, and that should augur well for Hero MotoCorp as well. And overall, the earnings overnight have been quite decent, so maybe that will lend some support to the market sentiment, because whether it was Bharti Airtel or a lot of other large cap names, they were all on the positive side. But let's try and understand all of that with our chartists as well. We have with us Naresh Mirani as well as Kunal Bothra, as always, joining us to help us tide over the technicals of the market. Kunal, hi, morning. Thank you so much for being with us. To begin with, are we likely to get out of this range? Do you believe after that, central bank event is out of the way, there could be a case of big rally?
I'm not sure whether it's a big rally, but I think, yes, there would be a chance that we would probably get out of the range. And the range has been very narrow for the index. So, earlier we were at 17,400 to 18,050 as a broad range for the Nifty on the spot levels. That range has contracted to almost 200 points. So, in the last 3 days, we've seen the index hitting a low of 17,600, and I think 17,830 approximately was the high the index made. So, broadly 200 to 20 odd points is the range for the Nifty over the last 3 trading sessions. And even yesterday, for example, the range was much narrower than that 250 points. So, the range is, it keeps on contracting over the last many trading sessions, and I think that probably would, expand post the event which is out of the way today. So, I would probably be of the belief that we would probably break out on the upside. The only fact is that if we manage to hold on to the two important supports, one is 17,400 on the medium term side as well as 17,700 mark on the spot levels Nifty. If we manage to hold about these two levels, then I believe that the chances of the breakout on the upside is pretty much high for the indices.
All right, let's get in Naresh's take as well. Naresh, posing the same question to you. After this policy event is going to be out of the, what is it that you're working with when it comes to levels on the index?
So as of now, keeping it very simple, till the time we are in this band of 17,400 to 18,000 broadly, time to be more stock specific, continue to focus on relative strength. But once we cross 18,000, which is basically the high made on the budget day, that is where the momentum shifts. We don't want to preempt this move as of now, because we are not seeing a breakout move happening in any of the sectoral or stock heavyweights. We have a Reliance Industries closer to 2,300. We have HDFC Bank still away from making a new all-time high. So till the time we don't get, say, at least one or two of the heavyweights in the Nifty, it is tough to call it a breakout as of now or preempted. So for now, being more stock specific, focusing on the broader markets and relative outperformers in the extreme short term. But once we cross 18,000, that is the time to get aggressive.
18,000 is that hurdle, and if you look at the rates coming in from the SGX Nifty this morning, it does give you some support that the market is going to probably start around that 17,795, so very close to that 18,000 mark as far as what the levels from SGX Nifty are suggesting. But Kunal, I wanted to get a sense from you with respect to the Bank Nifty as well. We saw a bit of outperformance yesterday. Today, do you expect that to continue? And the kind of move that we were seeing in Bank Nifty last year, could this be another year of a solid outperformance from Bank Nifty, you believe?
Well, there should be more strength for the Bank Nifty, but I would not say a very strong kind of a solid outperformance, which you may see immediately, because there are likes of, so the texture of the Bank Nifty has changed dramatically over the last 1 year. So start of the previous year, you had ICICI Bank, which was doing exceptionally well, SBI, which was doing exceptionally well. Somehow over the last, 4-5 months, end of 2022 and start of 2023, I think both these stocks, ICICI as well as SBI, they've lagged behind. But you have new leaders which have emerged in that case, Axis Bank, IndusInd Bank, the PSU banking stocks which had a fantastic rally. These stocks have gone to a correction. So their mixture is changing a bit for the banking index, but it's just that the private sector banks are now taking the major share of the weightage on the upside as compared to the PSU banking stocks. That could probably lead to more confidence, because when private sector banks tend to outperform the PSU banks, we've seen historically that the rally tends to sustain for the indices and the Bank Nifty doesn't go into major periods of correction. So that's the only point of solace for the banking index. But as of now, we would still see many large cap names in the banking stocks which are still not participating.
Let's get in those top picks, Kunal.
So two buy calls. Poonawalla FinCorp is what I would suggest as a buy. Interesting breakout for the stock yesterday. Targets of 320, stop loss at 290, and the second would be a buy from the auto ang space, Motherson, Samvardhana Motherson. I think that stock as well has managed to break past above its 200-day moving average. So would suggest a buy. 88 as a target, stop loss at 75.
All right, Naresh, let's get in your top trades.
So first is the buy on Kotak Mahindra Bank. A risk reward trade here. The stock is trying to reverse from that support zone of 1750, 1770. Last 2 days it has shown a little bit of relative strength. So a stop loss at 1740 and a target price of 1900. Second is the buy on L&T Finance Holdings. Like the whole financial pack, we've seen one by one M&M Fin or IDFC make a new 52-week high. L&T Finance Holdings over the last 1 year has multiple tops around 95, 96 and has created a higher bottom and started reversing. Expecting it to cross into a new 52-week high, preempting that move, stop loss at 86 and a target price of 100.
These are the top bets coming in from charters this morning, but as we are flagging out, the big outperformer this year so far has been the IT sector. We spoke with Vikas Khemani, the founder at Carnelian Capital Advisors, to understand whether there are more legs for this rally to continue or not.
We have been very bullish on the technology sector per se. There are two types of this technology sector. One is the IT services, which I, where the names like HCL Tech and LTI play a role, and they have been doing very well. They have been doing in the range of 13 to 15% with a good dividend yield, and we think that that's quite possible. We continue to believe that there's a good tailwind in the entire IT sector that's likely to continue, and I think we're more playing, this is the IT sector right now is might be more combination of growth and defensive, and especially when in an uncertain environment, it also offers in some sort of currency hedge. So that's our thesis there, and we continue to remain positive on that. Companies like Tejas Networks and all are very different. They are more into manufacturing and technology. It's a combination of that. They're into telecom equipment space, and this company is, is a very, very high promising company from a capability perspective. They have a huge amount of capability on the 4G and 5G side of equipment, and with Tata coming in, their initial problem of capital and credibility, despite having capability, was a question. But with Tata coming in, both credibility and capital availability has got sorted out. So this is a really, in my opinion, 5-10 year trend. It has the potential to become Huawei or Nokia of India in that sense. Whether it will become or not, we will have to see in time. So we, in this kind of place, we are not really looking from a short-term perspective. Single order from BSNL could be 20-30,000 crores, and which will change the game of the company.
The fact that there was no change in the capital gain structure this time, can we assume that this is some kind of an endorsement by the government that equity will get a preferential treatment?
We don't want to keep changing too many things in too few short time. Capital gains tax, the last amendment was probably in 16 or 18?
2018.
18. And subsequent to that, ideally even 3 full years of not even gotten completed. So do you want to change the policy immediately? No, you would want to see how it works out.
Welcome back to the market. Let's get in some more top fundamental calls then. And Sanjeev Bhasin of IIFL is betting on Bank of Baroda and he's also bullish on SBI.
So my first pick today would be State Bank of India. Undoubtedly the best ever results in its history. 14,500 was the net profit, highest ever net interest margin, highest ever net interest income, and best asset quality. At 550, it's a steal. I think State Bank is headed to new highs. And I think a global rally is on the cards in the next 15 days. So look for targets of 600 rupees on State Bank by the end of this week or next week. My second pick for the day would be Bank of Baroda. I think Bank of Baroda has come out with the most stellar numbers ever. Their asset quality, net interest income, net interest margin, and the management commentary is extremely bullish. People are talking of 16%. They've done a credit growth of 20%. Their CASA ratio is the highest. And I think at one time price to book at 160 rupees, Bank of Baroda is it's a must have in your portfolio. Look for targets of 185 maybe by this week or next week, but it will lead the bank rally. Bank of Baroda is a must have. Keep a stop loss of 152. 185 is coming in Bank of Baroda.
Okay, Bank of Baroda is the top bet coming in from Sanjeev Bhasin, but the stock which was in spotlight yesterday was Paytm. That saw a solid rally on an intraday basis of almost 16 to 17%. By the end of the trading session, it cooled off definitely, but still positive momentum there. And today as well, there's the positive news wherein Macquarie has come in with a double upgrade on the counter. They're now upgraded the stock to an outperform rating with a target price of 800 rupees. They have lowered their loss estimates for FY23 to 25 and said that they're surprised positively on the distribution of financial services revenue as well. Not just that, Zomato was one stock that at the end of the trading session saw a huge spike of 6 to 7%. There was that tweet also that came in from the founder Dipinder Goyal talking about how they are very close to the path of profitability. And that's something what CLSA is also saying this morning, wherein they believe Q3 FY23 could be a turning point for the company and they're expecting a significant improvement in the profitability. Nuresh, let me come to you and talk to you about a couple of these counters, Zomato as well as Paytm.
So too early to call a bottom in either of them because what we've seen yesterday in a single day price action for Paytm tells you that the market is not ready to take it higher in a very strong way. Zomato is forming a base, so they are both in the early phases of forming a base. The way we've seen a recovery in Paytm, it could be very similar to the recovery we saw in Zomato, wherein the stock went up from 40s to almost 70 odd levels, and then slowly continued to decline back to the same prices, and then has started recovering. So if we look at it, a similar case has been happening for Zomato. Paytm, it earlier bounced back from 550, went to 800 odd levels, made a new low at 450. And yesterday's move was also not very inspiring for the fact that the stock from being 20% up ended up being hardly 6-8% up. So as of now, we are in this basic base formation in both these companies and it could take months together. So, and say after a fall of 50-70%, it takes at least 6 to 12 months to form a base and we are still early into that scenario as of now. So unless one has a view of more than 12 months, the stocks don't look interesting.
All right, Kunal, let's get in your take then on ITC. Clearly has been, in the spotlight of late, given the fact that there's also news reports of government weighing that stake sale. What's the view on ITC on the charts? And Varun Beverages, after the fact that we've seen a pretty smart rally play out, brokerages as well have given the stock a thumbs up. What's your view?
Well, I think ITC I would still be bullish. I think even after yesterday's price correction, the stock still seems to be on course for going past about that 400 mark. But it's said that the pace of rally for ITC should slow down significantly. What we've seen in the last 3 to 4 months earlier for ITC was the stock consolidating at the 325, 330 mark for a lot of period of time and then the stock going into a breakout mode. I think we could probably now see a patch of consolidation back again for ITC. So I think that's something which I think a short-term trader should probably wait out for. Varun Beverages, on the other hand, even after 2 days of strong price action rally, I would still expect the stock to get into a correction. Now, I think 1290 approximately is where the stock closed yesterday, but I would expect the stock to come back towards 1200, 1250 mark. So a correction of 3 to 4% from yesterday's high, I think yesterday's close, I think is a better level to buy Varun Beverages.
Yeah, so probably look at the yesterday's chart, another 1 year chart of Varun Beverages of a You've got Kunal flagging off those levels after yesterday's pretty phenomenal move of nearly 7%. Okay, let's move right on then, connect with the management then of Kalyan Jewelers. Ramesh Kalyanaraman, who is the executive director at Kalyan Jewelers, now joins in on the show. Thank you so much for taking time out. Let's understand your demand trends, how they've been shaping up. Has there been any impact, largely on the back of the sharp rise that we've seen in gold prices?
Yes, Q3 was extremely positive. Our revenue grew by around 13%. And in the Q3, the last 3 weeks in the December, the momentum was a bit muted, especially because of the gold price volatility. But January, everything was normalized, meaning people have adapted to the high gold price. Demand is back, strong momentum again at the stores, and it's across all the markets in India and Middle East.
Okay, Ramesh, so that point is taken, but you also hinted that there is still some pain when it comes to the lower ticket levels. What are you doing to mitigate that, and by when do you think this will improve?
In December, the last 2-3 weeks, the discretionary demand was a bit muted because of the high gold prices. Usually, that kind of demand only people can delay. Wedding demand, people cannot delay more than a week or 10 or 15 days, right? Because the wedding has to happen on the date. But now discretionary is also on track because it always takes some time to people to adapt to the new price. So January is back on track.
Of studded jewelry sales were at 27% in Q3, higher than the previous quarter. What has led to this growth?
So as you know, studded jewelry growth in Kalyan Jewelers, there are majorly two drivers for that. One is, of course, the non-South markets where we go and expand because non-South comes with a higher studded ratio. And again, an organic growth within the existing stores as well. So these are the two growth levers for our studded ratio expansion. And if you look at our expansion plan for the calendar year 2023, we will be opening 52 showrooms. That is our plan. And predominantly everything is non-South, which will help to improve our studded ratio further more.
And Ramesh, just before we let you go, wanted to get a sense on the EBITDA margins as well. Now, despite the increase in the studded jewelry that you talked about, we didn't see a big improvement in the margins. Are we likely to see that in the coming quarters though?
So EBITDA margins, first of all, it's not comparable with the last year because we did not have any franchised showrooms in Q3 last year. Now we are into franchise. We have a bunch of franchise stores which is working in Q3 as well. And as you know, franchise is a FOCO model which we are working, and the EBITDA margins for franchise stores will be lesser, but it will be the PBT will be on a higher side. So it's not actually comparable. And again, also to cater to the expansion plans of franchisee stores, which I just mentioned, we added approximately 900 employees across various levels. This has resulted in certain pre-operative expenses towards a salary, training, etc. So these are the major takeaway for you, EBITDA margins.
Okay, Ramesh, we'll let you go on that note. Thank you so much for joining us. But not just Kalyan Jewelers, we'll also have Hero MotoCorp, which will be in focus on account of earnings. Let's discuss that and a whole host of other stock ideas with Hemang Jani, the equity strategist, senior group VP at Motilal Oswal Group as well. Hemang, hi, good morning. Let's start with Hero MotoCorp itself because the brokerages are quite positive. The gross margins have surprised. The management is talking about market share gains, plus the fact that there's going to be a double-digit revenue growth for the industry in FY24.
Good morning. I think numbers have been quite in line, and what we have seen is that the two-wheeler as a category has actually not done that well when you compare it with the CV or the passenger vehicles. And within the two-wheeler category also there is a divergence of performance. When you look at TVS, it seems to have done much better versus a Hero or a Bajaj. But the recent trends, both in terms of Bajaj and now Hero are indicating that things are looking slightly better. And as this is the only category where we think that the valuation comfort is very high for a large cap company. So I think you might see some stability there, and you might see some up move, let's say about 10, 12, 15%. But again, in terms of high growth, we still prefer a passenger vehicle like Maruti Mahindra compared to a two-wheeler.
Let's move on then and focus in on the stocks that are on the editor's radar. A lot of those new age tech companies certainly in the spotlight, and that after Paytm came out with their overall numbers, the fact that it really pleased the street, the fact that they hit that operational profitability ahead of the September guidance. And Nikunj, in line with this, we've seen some of the commentary from the other new age tech companies like Zomato talking about hitting profitability. Nykaa has been profitable, but they're going to sustain costs up 10%. They clearly now may be coming back into favor?
So I want to start first with Paytm, because that in a sense is really the occupying the center stage, so to speak.
The Macquarie report.
Why is this report important? Because they were the first one who came out with a massive downgrade on the stock when it went public. Guess what, guys? Macquarie has changed their view on Paytm. Now they've maintained a very bearish view on Paytm throughout its listed journey, but now Macquarie, this morning a mail has hit my mailbox. That's 8th of February, 800 target price. That means it's a double upgrade. The point what they are making now is that our view at 2100 was based when the circumstances were different and the price was different. The price has changed. The business environment is looking strong. They are growing. We looked at the Jan data also, which just got released in the morning. And now there is a clear commitment towards path to profitability, and minus their UPI business, their payment business, other businesses are also showing signs of signs of growth. So there is merit in now re-looking at Paytm the way we've really looked at Paytm in last quarter. The challenge for Paytm, what I see, Avan, is that there is supply. There's supply from Alibaba, there is supply from SoftBank. You've got large P investors and large marquee investors who've been selling every time the anchor lock-in is getting out. And we've seen that in yesterday's intraday graph also. Look at the Paytm stock yesterday. It was flying, cruising smartly, but then comes the intraday move. Zomato goes up, Paytm comes down. So I think Paytm now qualifies as a stock where markets are convinced that the path to profitability is there. It's a judgment call at what price you want to buy, but this is a stock where everybody was selling at every price irrespective of the decline. Now will be a stock where you want to hold or you want to buy on a decline.
Okay, that's Macquarie completely changing its stance on Paytm. Watch out for that stock in trade, but then we're also discussing InfoEdge in closer detail as well. And incidentally, it's Macquarie as well that has come out with their report talking about the sum of parts for InfoEdge.
Okay, now InfoEdge, if you look at the sum of part, that's what you look at it. And sum of part, just to break it for our viewers, essentially means that when you value a business, how do you price it? For example, with Reliance, you value Reliance with different businesses, Geo, refining business, the retail business. For Macquarie, for InfoEdge, 50% comes from the basic business, which is the jobs business. But the remaining part of the sum of part valuation for InfoEdge really comes because of the investments they've done. And two large investments there, both of them have gone public, Zomato and PB Fintech. My limited point is that if the new age stocks are making a comeback, the sum of part valuation for InfoEdge, given that large part of that, nearly 25%, is still getting derived from Zomato and PB Fintech, and there's some other businesses they've incubated, will change. The stock got re-rated in 2020 and 2021 because of the surge what we saw in some of the fintech and new tech companies. Now I think the derating which has happened after the crash and collapse in the stock price of some of these new tech and fintech companies, that's behind us. So if some of the new tech and fintech companies, they start making a comeback, I will not be surprised that the sum of the part valuation for InfoEdge will start changing. This may not be the wonder boy for the day, but incrementally going forward, I think markets will start recognizing that.
Okay, there you have it. So largely focusing on some of those new age tech companies. And Pankaj Murarka as well has been pretty bullish and been acquiring some of these companies, Anisha. So let's find out his take on the entire basket.
Oh, well, yes, Pankaj, hi. Thank you so much for joining us this morning. And that's exactly my first question to you. Do you also concur with the view that the derating is over? And if yes, what are you buying at the moment from this pack?
Well, we are firm believers into these internet companies. I think last year was a year where we saw significant price erosion on these companies, but that was primarily because I firmly believe those IPOs were mispriced and there was a lot of enthusiasm in that sense. But I think now the fact is that after having got listed, these companies have made significant pivots to their business models, where they realize that eventually businesses have to generate cash for their shareholders. They have to make money and generate cash for shareholders, and we've clearly seen all of these companies making very rapid pivots towards that. And as you rightly said, after sharp price corrections, valuations have become much more reasonable in that space. So we like many of the names in the space. Overall on the space, we remain very excited because we think this is going to be one of the fastest growing space within corporate India over the next 5 to 10 years. And yes, we have ownership across Paytm, Zomato, and PB FinTech within the space.
Well, the path to profitability is getting defined and it's getting crystallized. My limited point is that the supply from P investors and anchor investors is so large that for next couple of quarters, there is going to be more supply and less demand.
Well, I agree with your point, Nikunj, and I think that's fair on part of those private equity investors because they have been early investors into this business, and some of these investors have already been invested in these business for now almost 7, 8, 10 years. But having said that, being a fundamental investor, and if I look back at my experience of last 25 years in market, if the underlying business is strong, the business will find its own value, and there'll be enough takers for that. I don't think so there'll be dearth of buyers. And as you said, some of these private equity investors might want an exit. I'm sure there'll be enough takers wanting to take whatever stocks they might have to offer, because eventually stock will gravitate towards their intrinsic value.
So, what's your outlook then when it comes to some of these businesses in particular? I wanted to discuss Nykaa. Given the fact that the company has been profitable from day one, now the management as well saying that they're going to sustain their costs up that 10% level going forward. Why do you think the street had punished Nykaa so much? Was it purely because of that bonus issue, or were there some other underlying factors?
Well, I think, as I said, probably these businesses at the start of last year when they got IPO'd, to my mind, they were grossly mispriced in terms of IPO pricing. And I think they were riding on the tailwind of globally, a lot of these internet companies were doing phenomenally well in terms of the stock price movement. With rising rates in US and probably a reality check, I think we are finding these businesses are now getting measured or valued more in terms of traditional and sustainable valuation metrics, because eventually the fact is the business of business is to generate profits and cash flows for the shareholders by delivering whatever goods and services to customers. I think Nykaa itself was, in terms of valuations, was pretty rich in that sense, and now probably we've seen moderation in that. The good thing about these businesses is that they're going to be on a very high growth trajectory. Most of these businesses, given that customers and consumers are making a rapid pivot to internet, and we are seeing significant increase in digitization and adoption of technology, will continue to grow at 30-40% to my mind over the next 5 years. And the good thing is most of these businesses, the nature of internet business is that these businesses are businesses with very high fixed cost structure, which effectively means once you reach certain threshold levels, then incrementally the operating leverage plays out, and the incremental delta to profits is very, very high. And I think now that these businesses have reached operational break-even, the incremental profits for these businesses will be significantly higher over the next 2 to 3 years, which should get reflected in their P&L.
Okay, Pankaj, really appreciate your time and thank you for joining us. I'm going to go back to Reliance and just let's have a conversation going with Hemang, Kunal, and again Naresh to understand that is Reliance becoming more like a stock which is jamming the market from a free flow. In last 1 month, Reliance is down 11%. Let's look at Nifty in last 1 month. Now, the numbers were not that bad. Their adjustment to windfall tax, I think that is clearly behind us. But optically, this is one stock which in a sense is now massively underperforming, and this also could be a function of that FIs are selling. Hemang, why is that Reliance is on the receiving end?
Yeah, so Nikunj, 2 points which you also covered. One is that you had a massive sell-off in the last 2 months, more than $5 billion, and Reliance was one of the widely held stock by FII. So that was one of the reasons. And of course, the windfall tax came as a big negative surprise. And as we have seen that you have seen. Quarter on quarter, indication on what sort of windfall tax regime they are going to have. So these are the things that the markets do not like. Market likes simplicity and less of surprises in terms of government intervention. So I think there is a certain amount of de-rating because of that. But having corrected quite sharply in the last, let's say, few months, I think the risk return from here on looks quite compelling. The numbers have been good. The retail business is shaping up pretty okay. In telecom part, I think the story remains pretty much good in terms of the ARPU revival and 5G rollout. So we do like Reliance, and I think it provides a good entry point.
Yuresh, why is Reliance underperforming? And if the Reliance underperformance is real and it's here to stay, then that means Nifty is going to get jammed.
So Reliance has been underperforming for the last almost a year or so, as well as the stock is available at the same prices as it was in September 20. After the whole fundraising, etc., got over, the stock peaked at closer to 2300 odd levels, and that has been the pivot point for the stock over the last 2 years roughly. For the whole of 2020, 21, 2300 was a resistance. Post that, now 2250, 2300 has been a support. So we went there in 2022 almost 3-4 times, and now we are back here. So whether it can hold about 2250 and again see that range bound move, that seems to be the possibility wherein we again go back to 2500 levels. So actually out here it's a risk reward trade wherein you say keep a stop loss at 2240 levels and expect a bounce back towards 2500. So as of now, there is nothing to say that the trend has changed on the downside. It's been sideways almost for more than a year, year and a half, and it still remains to be sideways wherein you want to buy the dips with a stop loss and sell on a bounce of 10-15%.
Hemang, morning. Wanted to get in your take on the cement basket because news reports are indicating that the finance minister has told the industry that there could be a possibility of lowering the 28% GST on cement, and that will be looked at a step towards easing the construction costs. This would come in as a huge shot in the arm, right?
I definitely think so, Avan. I think if you have any move from the government about lowering the GST rate for cement, definitely it will be positive. And I think if you look at the quarterly numbers across the companies, be it Ramco Cement, Ambuja, ACC, Ultratech was a tad, disappointment, but the numbers have been pretty good. And given the fact that this is going to be 1 year before the election, the kind of order awarding by the government is picking up pace, which is good for the cement sector, and the real estate sector anyway is doing well. So I think we continue to have positive view. I think Ultratech, Ramco Cement, Dalmia, these are our preferred picks within that sector.
Okay, so those are the preferred picks when it comes to cement sector, but what's the preferred pick from the entire capital goods space? Do you continue to stay with the leader L&T or impressed with the numbers coming in from Thermax?
So we have a positive view on the capital goods space, and I think this is one sector which has remained strong even amidst the volatility that we have seen in the last few months. And we think that names like L&T, Siemens would continue to do well. Apart from that, I think the mid-cap, cap goods companies also would remain in focus. So I think, it would be good to have a reasonably good amount of allocation towards the capital goods, space at this point of time.
What's the take, Hemang, when it comes to Bharti Airtel? The fact that there was that sequential decline in their profits impacted by that license fee provision. You did see on the operational front, the EBITDA has increased about 5%. What has been your key assessment given the fact that now we're eagerly awaiting the 5G rollout by March next year?
So I think the numbers have been in line. Bharti has been showing very strong subscriber addition. and the overall performance has been good, but there is an overhang in terms of the debt that the company is sitting on, and with 5G rollout capex, it may not look that great. So at best, we think that Bharti will remain broadly in a range where we are, maybe 5% plus or minus. But if there is any meaningful correction because of the overall market correction, definitely this would be one stock to add, because I think from a 2 year, 3 year kind of a perspective, this will remain one of the cleanest telecom story that we can have.
But if I may just throw in one more ingredient, Hemang, 5G, it's a stretch on the balance sheet and not such an incremental jump in terms of the ARPU or in terms of the return on capital, at least for next 3 to 5 years. So the challenge is that while telecom companies will have to spend top dollar to expand their network to 5G, the incremental benefits in the near term may be lagging.
Absolutely, Nikunj. I think there are 2 points. One is that the overall debt, because of the high capex that they have undertaken, it continues to remain high versus what the management indicated about the free cash flow, 1.5 year back. So that's definitely a big overhang. Secondly, the ARPU increase has not been that great. Once we saw that 20-25% ARPU increase recently on the entry price, they have revised it. But again, at an aggregate level, the ARPU remains quite okay, and there is not much of growth. So unless we see a meaningful growth in the ARPU and the debt level remains a little lower, the stock will remain a bit muted.
Okay, we were also talking about, Hemang, the strengths that we have seen in the Nifty IT this year. Of course, last year we had seen the deep cut of around 25%, but this year it's managed to make a bit of a reversal, with the index gain being around 5 to 7% so far this year. But do you believe that mid-caps are the ones which would lead the gains this year? We have seen a positive note come in from Nomura this morning, whereas they have initiated coverage on Coforge with a target price of 5,050. You had the stocks like Persistent System, which have already jumped up 25% this year. What's your top bet from the IT pack? How are you playing it?
So our sense is that in terms of growth, the mid-caps are leading the pack, be it Coforge or Persistent, LTIM and so on and so forth. But when we look at the valuations, they are much, much higher compared to the large caps. So, the comfort definitely is towards the large caps, where the numbers have been reasonably good, be it Infosys, HCL Tech, TCS, and the valuation comfort is also there. Plus, they have done a major buyback. So, at this point, rather than chasing the mid-cap ITs, we would be more comfortable buying into a TCS, Infosys, or an HCL Tech.
Naresh, who would have thought at the beginning of the year the outperformance in IT is going to be so large? I'm comparing that with the bank Nifty and also with the index per se.
So, say most of us in September, October expected the bottom is done and a 10-15% bounce, but the current fall in banks is something which came out of was not expected, given what was the surrounding the trend as of now. So as of now, the view is very simple. IT, the bounce is done for the near term. In the large caps, so at 3,500, you don't have much of an upside for TCS. But in the smaller names, there is still a lot of upside left. So LTI, Mindtree, LTTS, the ones which have corrected almost 50-60% from the tops, can see a lot more recovery. We've seen a strong recovery in Nasdaq also. So overall, positive on the IT sector. Banks continue to be leaders on a medium term outlook. And we'll see some of the banks like HDFC, Kotak, which have not done well, or SBI, ICICI, which were leaders and corrected. They could now be staging a comeback, and overall banking still looks interesting. After this recovery, IT is something one needs to be careful on the large cap side.
Kunal, what's the outlook when it comes to the entire auto space? Hero Moto, is that going to be closely watched out for on the back of its numbers?
Well, it should be because I think the auto stocks or the auto sector rather requires a lot of the stocks to start firing up one by one, because as of now you still have the likes of M&M, TVS Motors, Escorts to a larger extent. They are the ones which are looking quite strong, and they're the ones which have managed to shield themselves from this recent market volatility. Even Maruti, I think, has made a good comeback from that 8,000 mark to 8,700, 800, where it's trading right now. But the most of the other stocks, Hero MotoCorp, Bajaj Auto, even Ashok Leyland in that regards, I think the stocks have more or less disappointed. They've not gone into any kind of a major recovery, major rally, or even let alone a breakout for themselves on the medium-term charts. And I think that's the concerning point from the auto pack. You'll have a phase where most of these larger cap names, M&M, etc., these stocks would tire out, and in that phase of tiring out, you would have many of the other underperformers which could probably take the beaten head. That's the only concern why you don't see any major follow-through price action for auto stocks time and again. So I would probably expect that if Hero MotoCorp possibly comes back about that 2750 mark, that could be a point where the stock may get into a strong turnaround mode.
All right, let's check in on the pre-open rates then this morning. And for now, though, it's a bit subdued on the frontline index. For the Nifty, we're down in the red by about 0.6%, and for the Sensex, holding hard by about 300 odd points. Hemang, wanted to get in your outlook then, in particular on what we've seen play out in the entire in the entire auto space, owing to the kind of management commentary that we've seen with respect to numbers, the fact that there's a positive view coming in on Hero Moto from Citi. You've got Maruti as well, Suzuki Motors saying that India remains a very strong market as we've seen the sales in Europe and Asia fall. What is this indicative of?
So if you look at the data, auto in January was the best performing sector, up 6%, while the index was lagging. And even the performance that we have seen from the likes of Maruti, Mahindra, some of the two-wheeler companies like Bajaj, TVS, even the auto ancillary company, the tire companies, they have been by and large pretty good, and the outlook also remains quite promising. So we think that the auto will remain in limelight, and apart from the this PV names that we like, which is basically Mahindra and Maruti, I think the tire names, something like Motherson, Sumi, will also be in the limelight, and it would make sense to participate in this growth story, which is actually moving forward despite strong outperformance in the last about 12 to 15 months.
Okay, so that's a take on how to play the entire auto pack, but let's get some mid-cap strategies going with our chartist. Kunal, you go first. What's the top mid-cap bet this morning?
Well, I'll continue to bet on Better Foods, a stock which we discussed a couple of days back as well. Very interesting chart. The stock making a fresh multi-month high yesterday, coming close towards that 490, 500 mark. So would suggest a buy. 520 remains to be a target. 470 as a broad stop loss.
Okay, and yesterday, of course, the numbers from Mrs. Bector were out, and they were quite a strong set, both on the top line as well as the operational performance as well. But Nuresh, what about you? What's making it to your list of recommendations?
So that's a buy on NCC with a stop loss at 88 and a target price of 110. The stock is on verge of a last 2-year breakout. The stock made a top at 93 to 96 levels very recently for 2-3 months. Back in 2021 mid, as well as start of 2021, it made 2-3 attempts around that area. So it would be a big cup and handle or inverted head and shoulders breakout here. Once that crosses, the ideal target would be 120 to 150. For now, a short-term target price of 110 and a stop loss at 88.
All right, let's move on then. And here are some of the other top